Traders, welcome to this very, very special institutional Sunday. One not to be missed. Do you trade cryptocurrencies? Is covered. Do you trade Forex? Covered. Commodities? Covered. Treasuries? Covered, right? We're going to be focusing a bit on crypto and I'm going to mention why, but we're also going to obviously, as always, look at equities. But very special institutional Sunday because we're going to be looking at not only what happened last week and projections for next week, but also projections for 2022. So definitely one not to be missed. Can't wait to get going. Let's step into it. So as I spoke about there in my intro, I do want to talk a little bit about Bitcoin, which I've highlighted here. Obviously the focus will be on kind of this week and what's actually happened in markets this week. And I'm always talking about the S&P 500, but I think people need to realize that the factors that I talk about, they're affecting all markets, including cryptocurrencies. We can see here FX, Forex, right? Dollar yen, pound yen here. We've also got the US Treasury in green there. We've got crude oil. We've got Bitcoin in pink, and then we've got the equity market. And I'm going to show you, end of the day, I know needs to be some room for opinion, but it's also important people look at the facts. And I believe most people, 99% of traders, ignore the facts that are right in front of them. So like I said, we are going to look at some amazing stuff, the stuff that actually drove markets this week. I always say it, I'm not talking random squiggly voodoo black magic Fibonacci junk. I'm talking the actual stuff that's driving markets in the real world, on planet Earth, where actual professional traders are trading and not all of this nonsense I see around, which is backed up here. So you can see we're going to look at some amazing stuff today that you're not going to find anywhere else. I've got the football scores there, and there's a reason for that. It's to do with Omicron. But you can see there were some real serious reasons why the market behaved the way it did this week. FOMC, producer prices, Omicron headlines, and we're going to go through all of that. But coming back to the point, and it's a really important point, and that's why I labor the point, because people just don't seem to understand, and I want them to understand. That's why I keep saying it. I want people to do well. Let's look at the facts, right? Early part of the week, generally the equities had a positive move off the FOMC announcement, right? That they were going to be tapering, and it was a bit odd. It caught everyone by surprise. People were expecting a bit more of a bearish reaction, but that's not the point. We're going to get into that. The point is, look at the other markets. So equity markets rallied right here, early part of the week, S&P 500. What did Bitcoin do? Rally, okay? What did dollar yen do? Rally, right? What did pound yen do? Right? Rally. What did the US Treasury rate do? Right? Rally. So at the end of the day, these markets are all correlated. Even crude oil, although it didn't rally, it was fairly supported. Now let's look at the back end of the week, right? So I always show this chart, and we can see here US equities had a sell-off, right? So let's have a look relative to other markets. US equities had a sell-off, which we just saw there, right? Don't need to take my word for it. It's here in black and white. It's very, be foolish for anyone to ignore black and white, basically. What happened in the energy markets? Sold off for similar reasons. Pound yen sold off. Dollar yen was fairly flat. The treasury rate sold off. And what happened to Bitcoin? Sold off, right? And went to kind of recent lows. So that's my point. Look, these markets, including Bitcoin, they're all interrelated. And there's reasons for that. Like I know Bitcoin is obviously influenced by things like its real world utility. How useful is this as a transactional currency for companies? How many companies are adopting it? And all those things matter. Of course they do. But ultimately, it's an asset that is a high yielding asset. And if money is looking for a home and people are feeling quite bullish, they're going to start investing in high yielding assets like pound yen, like Bitcoin, like equities. If they're feeling risk averse, which we saw towards the end of the week where Omicron Headlines were quite high, hence the football scores, and I'll go into that. But the point being, money doesn't want to be in high yielding instruments or assets. It wants to be in safe havens like treasuries, and that's why you see the treasury rate falling off, i.e. rallying because money goes into it. You see Bitcoin falling off as money comes out of it, equities falling off, money comes out of it, and so on and so forth. So, that's the final word I'm going to say on that before we really move on. But it's just really sad to see people talking out of where the sun don't shine about Bitcoin and why it's moving up and down because of random Fibonacci and lines on their chart. Complete and utter. Never heard so much rubbish in my life. It's moving because money is going in and out of it, being driven by factors that are driving all markets, right? And this stuff is not complicated. Anyone can understand this stuff, right? I've just pulled this out of publicly available sources, so we're going to cover that today. I had to make the point because I don't want people to think I'm just sitting here going on about equities. It isn't. This stuff is relevant to every single market. I'm going to repeat it again. Crypto, Forex, treasuries, energy markets, equity markets, the stuff I will talk about now in the next 10-15 minutes is what you need to be thinking about in 2022, regardless of what asset class, including cryptocurrencies. That is what is driving markets. So let's move on and get on with it. So look, coming into the week, we'll keep it pretty brief. We all know kind of what happened. It was a negative week for all markets, as we've just seen. I'm going to look at it from an equity lens because that's what I trade, down 1.9% compared to the previous week where we had a very positive week. But a couple of things to really take note of. Volatility is completely crazy right now, right? We're continuously getting the same thing as we had for the last 2-3 weeks, really. Plus and minus 1% days. Hugely volatile days. So that's number one, right? Volatility is affecting markets right now, and it's not a positive thing. When there's volatility around, people get fearful, they're not as confident about their investment, so it can tend to have a negative impact, and we're really seeing that coming through now. These lows, as I'm going to show you in a second, are so crucial. If we bust through them, then I think December, forget about the Santa Claus rally. That's not going to happen. If we hold, then we may see a Santa Claus rally, but we can talk about that. I'm slightly bearish now going into the end of the month, and we're going to talk about the reasons for that. But coming back to the point, number one, volatility. Number two, why? Right? Why did what happened last week happen? So let's just quickly cover that because it is important. So Monday started fairly flat. There wasn't really much data of note. We did, sell off the back of some continued Omicron headlines and things being a little bit negative. But that really continued into Tuesday, and a lot of the reports I was reading attributed that to PPI, which we're going to talk about very, very briefly. Crazy number, the highest PPI number since they were recording this data. Very, very high numbers. I think I got it written down somewhere here. We're talking 9.7%, almost 10% year on year in producer prices. Crazy, right? And that's an important number because it's the price of goods before it gets sold on. Then we had FOMC on Wednesday, and we had this massive rally and then a huge sell-off, right? And this was so confusing for everyone, including myself. But I think there's reasons for that, and we're going to talk about why I think that happened. And then finally, no data of note on Friday, but we did sell off, 1%, so quite a decent sell-off. And I believe that was down to Omicron headlines, which I think will continue into next week, and we're going to talk about that too. So in a nutshell, PPI, FOMC is the big one, Omicron, and then I'm going to talk about what to expect going into next week and even next year. So let's get on with it. Now, one of the things, I'm going to start looking at a little bit more of in Institutional Sundays is kind of a broader perspective. And if you look at this area here, the recent range we've been in December, it's actually this, right? What you see here. I talked about the lows recently being very, very important. And I just want to give you a little bit of a broader perspective on that, because I am going to talk about what I expect to happen going into the rest of the month, going towards kind of the end of the year. You can see the lows there, very, very important lows. If these lows break, we're going to be possibly heading down quite a lot. If they hold, then look at the Santa Claus rally transpiring. But let's have a look at what happened last week, and then I'll give you kind of my thoughts on which way I think the market's going to go. We talked about PPI first, so I'm going to rush through these. Shouldn't take more than around 10 minutes, but very important, because you're not going to find them anywhere else. Say it time and time again, but it's true. So that's the 9.7%, right, year on year, which I'm going to show you on the data calendar. Actually, if we look here, you can see it there, 0.8% month on month. So that was the Tuesday, right? And we're talking the highest rate since rates began, highest inflationary rate out of the gate. So I think that was a bit concerning for the market, because don't forget, this is pre-FOMC. This is pre the announcement that the Fed is now going to be much more hawkish. So I think the market was really worried. What if tomorrow the FOMC come out and they're not on top of inflation? So I think the market worried about that, and that's why equity market sold off. So that was Tuesday. Then we go into Wednesday. This is really just everything. I've been going on about this for weeks. This is so important. The FOMC meeting finally happened, and we saw the massive rally on Wednesday in all markets. So what happened, basically? So number one is the Fed have announced, as I've been going on about for a while now, that they're going to increase from $15 billion to $30 billion, the taper, so i.e. reduction in their monthly purchases of mortgage-backed securities and treasuries, which you see here. So you can see here, right, November minus 15 taper, December minus 15. They've now announced in January they're going to do 30. So it's going to go from 90 down to 60, 60 down to 30, and then 30 down to 0. So in March, there will basically be no more stimulus provided via the Fed balance sheet. So that's a very hawkish or aggressive stance to take to battle inflation, which we're seeing here, which you can see here. So that's the CPI, and that is the PPI. We know about this in kind of December. It's really started to rally. Number two is the dot plot, right? So this is the kind of median of where the FOMC members, each one of these represents an FOMC member, see rates, basically. So you can see the median is for 3 rate hikes. Okay, 3 hikes in 2022, and that is it's not very aggressive. In fact, I personally think, and I'm reading the consensus amongst economists, is actually for more, right? Possibly 4, but a lot of that is managing the markets, managing investors' expectations, not wanting them to get too freaked out, right? So I think the Fed is kind of going for 3, but it could be more given the way inflation is and the economic projections are for next year for kind of like 4%. GDP is what the FOMC have just put out in their forecast during the meeting. 3.5% unemployment rate, and I believe 3.7% core inflation, which is slightly higher than the prior projection. But that's solid economic data that they're expecting in 2022. So therefore, I think that they have room, basically, to be quite aggressive with hikes. But the point is, it's higher than it was previously, where they were only kind of projecting 2. So overall, basically, let's just summarize that. The FOMC's meeting, 3 rate hikes, £30 billion taper. It's about as hawkish as you can get. Now, I find it quite funny because you watch CNBC and all of this stuff, right? And they're all talking about the market rallied because the market was relieved that it wasn't as hawkish as expected. How much more hawkish can you get? 3 rate hikes and 30 billion taper, ending all purchases in March. You can't get much more hawkish than that. So complete nonsense to suggest that this rally was down to the market being relieved. I actually have my own opinion on it. I think there were two factors at play, right? And this is why, it's better to listen to a trader who actually puts his money on the line. If you remember the last FOMC meeting in early November, the market equally had a big rally. So I think mentally, the FOMC has been quite a positive, has been, the post FOMC meeting effect on markets has been quite positive. So I think it was kind of like self-fulfilling. A lot of the market was expecting the market to have a positive rally because that's been the kind of pattern. Secondly, I think the market was just happy to get this out of the way because for the first time in a long time, it was actually a meaningful meeting. In the past, it's just been like, yeah, whatever, they're meeting and fine. They're just kind of repeating a lot of what they've been saying pre-meeting. This time there was a little bit of kind of nervousness because there was the potential to switch from a very loose to a hawkish stance. It's a big change, this, right? We've seen them, Chairman Powell and his colleagues be very, very kind of supportive towards markets and very loose with economic policy. And this was a complete change. They've suddenly gone very hawkish. So I think the market was a little bit nervous about it just because this was on the cards, even though it was well kind of telegraphed by the Fed that this was going to occur. And then number three is, I think, this PPI, right? Don't forget, the market really was here before the PPI number. So actually the market relative to Monday didn't rally that much. It's this PPI number that pushed the market down because we had that 9.7% PPI number, and that pushed the market down. So the market was like, oh, we're relieved that the Fed is going to be dealing with the inflationary issues that have been highlighted on Tuesday. So it's kind of that effect. We then sold off on Thursday, and everyone's like, hey, what on earth is going on? And I think what basically happened is that Wednesday was kind of that, like I said, get the things I talked about before. Just kind of a pattern of previous FOMC, post-FOMC meetings, and everyone thinking it's going to rally because that's been the pattern, so it rallied. I think once people actually digested the report, they realized it doesn't make any sense. 3 rate hikes and a taper ending. The market needs to price that in. Going all the way to new highs is not pricing in that news properly. So then the market started to digest the information and priced it in, essentially, that the Fed is going to be very, very hawkish going forward, which is not necessarily a positive thing for the markets, because obviously that support that's been there for the market since 2020 is no longer there. So the key question on everyone's minds is, moving forward with this, is the market going to collapse? Because now the Fed is very, very aggressive now, hawkish in terms of monetary policy. Is the market going to collapse? That's what we're going to look at now. So the answer is to look at the facts. It's all well and good people having their opinions, and I'm all for it, and I have my own opinions as well. But it's unbelievable. Just like with Bitcoin, where people just don't want to look at the facts before spouting rubbish, people don't want to look at the facts. I get a lot of people saying to me, hey, the market's going to collapse, the Fed is suddenly hawkish. Complete cobblers, right? Look at the facts, the evidence, right? It is not unlikely to collapse. Okay, let's look at previous instances, all previous instances of kind of after the first hike, right? After the first hike, 6 months later, on average, the market is up 3%. 12 months later, it's up 4%, right? In almost every single instance, going back, 30, 40 years, the market has always been up after the first hike. Let's look at the last 2 instances, right? So look here, 2015. So that's the first hike, right? There in Jan 16. This is going back to 2004, July 04. That's the initial, or June 04, sorry, and December 15. That's the initial rate hike. Yes, the market had an initial drawdown. Okay, here it was 8%. Here it was a little bit deeper, 12%. Post-hike, 14%. This was post-hike, 8%. But then look at the preceding move, right? Positive, very, very positive. So no, markets are unlikely to collapse. Are we likely to have a correction? That's a big possibility, right? If we look at 2015, we were in a manufacturing recession, so obviously slightly different economic environment backdrop, where we did have a big manufacturing recession that lasted 2 years, 14 to 16. So this was right? So if you look at before the first hike, we had a 12% correction a few months before. So, they're projecting now the first hike is likely to be, if you think about it, when's the taper going to end? March, right? Powell has been very careful to say, look, we're not going to raise rates straight away, but we're not going to wait too long. And that was in the Q&A. So the market, from what I've been reading in research reports from economists and etc., looking around June, right, 2022 for the first hike. What generally tends to happen 3 to 6 months before the first hike? Well, we didn't really get that much of a pullback in 2004. You can see minus 3 months, we were actually up and up. And then in 2014, we were down 12%. Like I said, it was a unique scenario. I think we could be somewhere in between. So we might be looking at something like a 5 to 10% correction in equity markets in the next 6 months. Then I think we get a hike in June 2022, and then I think we just go back up. Why do we go back up? Well, look, GDP forecast by the FOMC themselves is what? 4% for 2022, unemployment rate 3.5%, and inflation, which is one of the reasons why they will probably start hiking 2, 3, maybe 4 times next year. It's likely to be 3.7%. Okay, so that to me seems the most sensible forecast to have. Equities to have somewhat of a correction in the next 2 to 3 months at some stage. Don't know exactly when that's going to happen. Obviously, timing is everything. Which kind of leads me on to my next point. It's fascinating. This stuff is absolutely fascinating, right? If you claim to want to be a trader, have any interest in financial markets, this has to be interesting to you. Otherwise, how do you even start to think about the landscape going into 2022, right? This is what is going to basically drive everything next year. So, for the first time in a while, we haven't, last year we were very lucky. We didn't even have, I think maybe just even that one, and even that was not on a closing basis, right? On an intraday basis, maybe. And we had a minus 5% correction last year. I think 2022, that's going to change, right? And that's where I think the big kind of difference is going to be, is that the Fed is removing stimulus. So this year we've had heavy support from the Fed. What that meant was that the pullbacks were quite shallow. The market was going up and up and up, and these pullbacks were like 2%, 3%, going up and up and up. I think what you see in 2022 is a similar thing, like I said here. After first hike, generally the market is positive, so still expecting, don't think we're going to get what you see here, 23% year to date, this year up 23%. I don't think you're not unlikely to see 23% next year, because obviously the Fed is going to be removing stimulus from the economy, and that will undoubtedly impact the market appetite to go up. But I think what you're going to see is still moderate gains. Obviously, we talked about the reasons why: positive economic growth, and that means companies will likely be making money, and obviously GDP positive, so on and so forth. But what I think you're likely to see is much wilder swings. So you can see still a positive, that's kind of like 2021, this is 2022. Still positive, but look at these swings. I think what you're likely to see is some more swings, maybe even that 10% correction I talked about before the first hike takes place, right? And then maybe moves back up to all-time highs and that kind of thing, right? You're likely to see a little bit more volatility, maybe something like what you see here. That is basically what I expect. I know that's going into next year. We're almost done. A few more things before I just wrap up. This is another just chart to show stock market performance following initial hike. So you can see the two scenarios we just looked at together there, right? 2004 and 2015. Here you can also see 1999, 94, 96 and 87, 89. So you can see within 2 years, pretty much every single time bar, and in fact 99 was positive within 1 year. Majority of the time, you know, hikes are not affecting the equity market in terms of having a big collapse. What you are seeing though is volatility regime changes, and I think that is talked about that a lot. Something that's going to happen. So look, I know I went on a lot there, but very, very important. We've crossed off FOMC off the list, and actually I've given you an expansion into what I'm expecting next year. The final thing I just want to talk about was Omicron, and more short term, what we're expecting next week. I've talked about what I expect next year. Next week, right? And this is important because you know, on Friday we had a sell-off, and obviously this kind of sell-off off the back of the FOMC rally. I think another reason we sold off after the FOMC was, yes, people were actually starting to price in some of those hikes, which for whatever reason were not being done on the day of the announcement. Omicron, right, is starting, let's be honest, the headlines, and this is where we come onto the football. Look at this, postponed. Sports games, postponed. My team Arsenal 3-0 up, getting the Gunners. But look, on a serious note, sporting events, right? We're seeing that cancelled, right? We're seeing travel restrictions, right? Here in France and other European countries now, travel restrictions, right? Number 3, I think I just saw a thing about Denmark. Literally, as I'm talking here, going into tight restrictions. So more countries, you know, tightening up borders, and then work restrictions, right? More people, you know, and you guys will know this firsthand. We're seeing work restrictions now, office closures. So yes, you know, the not the transmissibility, the sort of death rates have not been as bad as the initial variant, COVID-19 variant, which was a positive the last time we spoke last week. But these closures are bound to have an economic impact, right? It's not good for business, especially heading into the seasonal period, crucial Christmas period. So that is where next week comes into things. Economic data wise, I really don't think any of this stuff is that important. So I don't think the economic calendar is going to be an issue. And in fact, I probably won't be trading that much. Bank holiday, obviously the Christmas Eve. I would suggest you guys also take the week off. I believe next week is going to be very volatile with Omicron headlines, okay? And volatility is very, very elevated at the moment. So I'm going to go out on a limb and say that, you know, unless the headlines start to calm down, and I can't see that because even sitting here, I'm seeing new headlines, you know, like Denmark going into more lockdowns. We could well see this low broken, and therefore that's where we ended, end of November, right? So we are up, I believe we're up just over 1% in December. So, you know, generally you'll be looking for that Santa Claus rally to take us back up to where we've been earlier this year. I'm doubtful, okay? I'm seriously starting to think that maybe we start to go flat on the month into next week. That's what I'm thinking. Obviously, I'll see as the week goes along. Click to subscribe. Hopefully that was useful. Beat the retail BS. If you want to hear more stuff that actually drives markets, click to subscribe. Have a great week, Christmas, New Year's. Wish you all the best to you and your family. Thanks for watching.